Okay, welcome to the practical part of the sniper strategy or of the technical analysis. Okay, so we are going to talk about market structure. Without wasting my time, let's move on. So we have three types of market structure. The first one is bullish market structure. Uh, bullish market structure. We have bearish market structure. And then we have ranging market structure. So market structure simply means the behavior of the market or the behavior of the asset you are trading. Okay, so bear in mind we have these three structures. We have these three. Every market, being cryptocurrency, forex, anything, we have these three market structures. Okay, so this is how they move. This is bullish. How bullish market structure moves. Okay, good. And this is how bearish market structure moves. Okay, now let me make the bullish one green so that we can differentiate them. Good. Okay, so and we have the ranging. Some call it consolidating. They are all the same. Ranging, consolidating, they are all the same. Okay, so let me make this one good. Nice one. So we have the bullish, which is the green one, the bearish, which is the red one, and then the ranging, which is the gold one. Okay, so today we are going to talk about bullish market structure. Good. So as I said this is how bullish market structure looks like, or this is how bullish market moves. Good. Okay, this is how they move. So someone will ask, why is it that the market doesn't move in a straight line just like this? Straight line just like this, but rather move, come back, move, come back. Okay, now this is the reason. You see, every market or every pair, you see, this is Euro CHF. Let me bring um the watermark so that you can see that it's Euro CHF. You can see that this is Euro CHF. So it is economy of a country, okay? And economy doesn't move straight or doesn't go high just like that. It goes high, it comes down, it goes high, it comes down. Why? The reason why it goes up, it comes down is like, assuming we start from here, the market will go up, come down, it will go up, okay? The reason why it will come down again is because when it is going up, it leaves something we call imbalance, okay? It leaves something we call imbalance. So when it is moving up, it leaves imbalances. Some people call it fair value gap. You can call it imbalance. Okay. So the market leaves imbalance. Imbalance or liquidity. Imbalance or liquidity. So if someone call it liquidity, the person is correct. So the market needs to come down. Okay. The market needs to come down to fill some of the imbalances or the liquidities, okay, because it cannot leave the imbalance there and go. That is how the market is structured to be. So the market will come down to fill some of the imbalance, then proceed its trend. Okay, so here, 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 it creates another imbalance here, creates another imbalance here. Okay, market will create another imbalance here. So it needs to come down and then fill it again. Okay, sometimes it fills all, sometimes it fills half and goes up. As going up, it creates another imbalance here. Okay, so the market will come down and then fill it, fill the imbalance. So that is why we see that the market doesn't move in a straight line, but rather in a zigzag form. Okay, the market doesn't move in a straight line, but rather a zigzag form. It leaves imbalance, so it needs to come back and then fill those imbalances. Now, this is what you need to know. We have these areas. We have these areas and then these areas. Okay, let me highlight it correctly so that you see what I'm talking about. See that we have area when the market is coming down and then another area when the market is going up. Okay, when the market is going up. So when we are in uptrend, when we are in uptrend, let me make this one red and then make this one green. I try to make everything simple for you. Oh, let me delete it and then we have this area when the market is going up, and then here the market was going up. Here market was going up. Market was going up here. Oh, why? Let me clean it so that it will be simple. Okay, we have these areas, and then we have these areas. Okay, so we can see that we have zones or we have areas when the market is coming down. This area you can see that the market is coming down. Okay, and this area you can see that the market is going up. Okay, I think everything looks messy right now. Let me draw everything first so that we will understand everything. This is the market structure. Okay, comes down to fill this liquidity. So when it's coming down, this is called retracement. We call it retracement. Okay, so this is called retracement. Okay, this is retracement. And then when the trend begins, we call it expansion. We call it expansion. Okay, so expansion. Expansion. Okay, so this is expansion. Now you will have another retracement, over here. Another retracement. Okay, and then the expansion resumes. Expansion resumes. Okay, so the green area are called expansion, and then the gold area are called retracement. Okay. I think we all can see. So we have the expansion, the retracement, the expansion, and then the retracement. So this is how bullish market structure looks like. Okay, this is how bullish market structure looks like, or it is. Good. So now let's move on. In bullish market structure, there are some things you need to know. There are some things you need to know. Okay, so let's continue. There are some things you got to know. Okay, good. These areas are very, very important. Very, very important. I will tell you why right now. These areas are very important. Good. These areas, we call them higher high. I will tell you why we call them higher high right now. Call them higher highs. Higher high, higher high, higher high. Why do we call them higher high? Because this high is higher than this high, and this high is higher than this high, and this high is higher than this high. That is why we call it higher high. Okay, so this high right now is higher than this high, and this high is higher than this high, and this high is higher than this high. So we call it higher highs. Now, let's go here. We call these areas higher lows. Higher low. This is a higher low, and then a higher low. Why? It's obvious because this low is higher than this low. This low is higher than this low. This low is higher than this low. So in bullish market structure, we form higher highs and then higher lows, higher high, higher lows, higher high, higher lows, higher high, and then higher low. You get it? Now, this I told you these areas are very, very important. Okay, these areas are very, very important. They are called BOS. BOS. Full meaning is break of market structure. This is a BOS. This is a BOS. This is a BOS. They are called break of market structure. Okay? They are called break of market structure. And this is most important thing. Here, let me make it different color so that you can see that it is. Let me make it white. Good. This the last higher low. You can see that this is a higher low. This is a higher low. This is a higher low. And this is the last higher low you see here. Okay, we can say that the market has changed from bullish to bearish only if this higher low is being broken. I repeat, we can say that the market has changed from bullish to bearish only if this higher low is broken. So let's see the market moves. It couldn't form another higher high and then come to break this low. Okay, here we can say that the structure is changed. You see that here it couldn't form higher high. You can see that this high shouldn't was supposed to be higher than this high, but it couldn't. Okay, it couldn't, and this high is lower than this high. Okay, so here we call it shift in market structure. Shift in market structure. I will give you all the full meaning right now, and we shorten it to call it SMS. Shift in market structure. So let me give you the labels. So higher high, HH is higher high. Higher high. HL HL is higher higher. HL is higher low. BOS is break of structure. Break of structure. So BOS is break of structure. SMS is shift in structure. Shift in structure. SMS shift in structure. And BMS is break of market structure. Now, these are very, 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 very important. They are very, very important. Oh, good. We are back. These are very, very important. So it's important to write them down to guide you when you are doing your market structure. Okay, so HH, when you see HH, it is higher high, HL is higher low, BOS is break of structure. Oh, I wrote break if structure. I will correct it right now. SMS is shift in structure, BMS is break of market structure. Okay, so let me correct that is for us to have the break of structure. Break of structure, and then this one I think spellings. Good. Break of structure. Okay, so these things are very, very important. We are going to use them. So here you saw that instead of the market to create another higher high, it didn't. It create lower low because this high it create lower high because this high is lower than this low. Immediately we see it, we call it SMS, shift in market structure. Okay, we call it shift in market structure, that is SMS. Now, whenever there is a bullish trend and you see SMS, you need to anticipate a break of market structure, or we need to anticipate bearish market, meaning we are changing from bullish to bearish. Okay, so now you see that we broke this higher low to confirm the bearishness. Good. So if the market is to continue, this is what it should do. It should come up for a retracement and then continue the expansion, come up for retracement and then continue the expansion. So this area is very, very, very important. This area is very, very important. Okay, this area is very, very important because it is the last zone. So if we break this structure, it means that we have changed from bullish to bearish. Now, these are the areas you should look for your entries. Here, okay, you should look for entries. You should look for entry. These are the areas you should look for your entries. Here, good. Okay, these are the areas you should look for your entries. Okay, nice. Okay, so these are the areas you should look to buy. So let me say you missed the first one. You couldn't buy here. You have to wait for a retracement and then you buy here. If you miss here, you need to wait for this whole retracement and then buy here. If you miss this one, you need to wait for the whole retracement and then buy here. Because I told you these areas are imbalances, so the market will feel it. These areas, they are imbalances. These areas, they are imbalances, so the market will feel it. Good, good. Okay, so this is how bullish market looks like, or this is how bullish market is. Okay, when you are doing the market structure in higher time frame, let's say you are doing it in the one daily time frame or the weekly time frame, sometimes you can find a nice opportunity in the for the retracement in the 4 hour or 1 hour time frame. Okay, in the 4 hour or the 1 hour time frame. Good. So although we buy in bullish market, but in some scenario we get sell opportunities. Why? I just said it. I said maybe you are doing your market structure and you see that the pair or the currency or the commodity or the coin is bullish. Okay, in the daily or weekly time frame, you can go to the 1 hour time frame and find sell opportunities. Okay, because the market will not move in a straight line like this in the 4 hour time frame. It will do something like this. The market will do something like this. See, it will, oh, the market will do something like this, something like this, something like this. Okay, something like this, something like this, something like this. Okay, and then start to go forward. Okay, so let me repeat it. Market will do something like this in the lower time frame. Okay, to do something like this before hitting the higher time frame zone, okay, or the higher time frame higher low. I'll talk about this again, so follow me now before going up. So although we might be bullish in the higher time frame, but when you go to lower time frame, you can see sell opportunities or sell ideas. Okay, you can see where you can sell the commodity or the coin or the asset. Good. Now this area is called point of interest. This area is called point of interest. Let me add it here. We normally call it POI. So POI is point of interest. So we call them point of interest. Why do we call it point of interest? We call it point of interest because it is the area we look to buy. It is the area we use to get into the market. It is the area where we place our orders, our buy orders. So this area is they are called point of interest. Okay, so if it is a 4 hour, we call it POI, 4 hour. Okay, 4 hour POI, 4 hour point of interest. And we will get into details when we reach the order block structure, order block part, or the order block theory. Okay, so this is called point of interest. POI, this is a point of interest. This is also another point of interest. You get it? So this is where we look to buy or we look to sell. This is where we look to buy or we look to we look for buy opportunity. Sorry. So you can write them down. And now let's go to the chart and see the rare scenario. If you didn't write, you can write them down and then you can pause the video and write them now. But we are moving on to the rare market to see how bullish market moves. Okay, so here you can see that it is bearish. From here it is bearish. Good. Let's see, this bullish is not long. Let me look for better example so that You see this is consolidating. You come to all of it, so don't worry at all. Good. So let's move on. Euro CHF has been bearish for a long, but we will still get good. 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 Okay, so let's okay, so let me try to play it back so that you guys get me. So go here. Nice one. So we are focusing from here to here. Okay, here to here. Now, if you try to draw your market structure, you see that we form a higher high. Okay, came down for the retracement, which is higher high. Form another higher high. Form a lower high. Good. Form another higher high. Nice one. So obviously, although the market is not so beautiful, sometimes you won't get it so beautiful, but you need to train your eyes to see it. Okay, you need to train your eyes to see it. Okay, so I think I can get clear example here. Okay, guys, let's use this example. I think you should get a better example because you are fresh. If I don't get the clear example, you won't get what I am talking about. Okay, so good. Let's use this one from here, then to here. Okay, so you get everything we are looking for. Now remember the shortings I made, or the shortcuts. We have higher highs, higher lows, BOS, BMS, SMS, POIs. Okay, so I told you to write those things down. If you didn't, after this, go back and then write them down. So you can see that here we have a retracement. Oh, sorry, we have expansion, a retracement, an expansion, retracement, expansion, retracement, expansion, and then retracement. Okay, and then retracement. I told you the reason why the market moves like this, because when the market is moving, it leaves liquidities. Okay, and when you reach liquidity, you understand it better. So let's focus on the market structure for now. So it leaves liquidity that the market needs to come down and then fill those liquidities, then move ahead again. When it is moving, it leaves liquidities below. So when it moves to a certain level, it needs to come down to fill those liquidities and then move again. So that is how the market moves. So now from our labels, you can see that this is higher highs. This is higher high. It's obvious. This higher high, another higher high, another higher high. There is a higher high here. Let me make it clear. Okay. Then the last higher high. When you go down here, you have higher low. You have higher low. Why is this sometimes higher low? Okay. Have higher low over here. Another higher low. Perfect. Very, very, very perfect. Good. So we have the higher low, higher high, higher low, higher high, higher low, higher high, higher low, and then higher high. Good. Here it is coming. It has not yet landed, so we cannot call it higher low. It is still coming. When we have something like this, when it comes here and then we begin to have something like this, then we can here call here a confirmed higher low. But until then, this is the most important zone. Okay, this is the most important zone. Good. This is the most important zone. So I told you that this, if we break this part, let's say if the market break this part, it means that we've changed from bullish to bearish, because this is the high last lower low. I told you this one, it is still running, it's not confirmed, so you cannot call it lower low. The one here is the last lower low. Okay, so if the market breaks this, it means that we've changed from bullish to bearish. Until then, the market is still bullish. So as a buyer or as a forex trader, these are the areas you should be looking for buys. So here we'll be looking for buy here. So you will extend our POI here. Okay, we will extend our POI here, and then we can label it and call it POI for our POI. Okay, and then when we get to risk management, you will learn how to use all these tools. So don't worry, just focus on the market structure. So we place our stop loss just below the POI. Okay, just below the POI, and a take profit will be on the higher high. When you get to liquidity, you understand why our take profit is here and then our stop loss is here. So we don't just buy when the market reach here. Okay, we wait for certain confirmations. I will tell you later. We will wait for a certain reactions or a certain confirmations before we buy or we get into the market, because we don't know whether the market is going to change from bullish to bearish here, or it is going to continue, it's going to form just another lower, higher low, and then continue the bullishness. But since it has not break this structure, we have in our mind that we are in bullish, so we will look for a bullish opportunities or a signals or a signs that shows that we are going to resume the bullishness, and then we get in. Okay, so let's play the market and let's see if it is going to change to bearish or we are going to continue the bullishness. Okay, 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 let's see, let's see, let's see. Mm-hmm, mm-hmm. Boom. Okay, 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 okay. So you all have seen it. I told you that this is the place we buy it. And then obviously you can see that when the market reaches this area, it begins to go up again. The market begins to. So let's play and let's see if we can hit our take profit. So this will be our take profit, the previous higher high. Okay, let's see if we can. There are some trade management. We talk about that later. We have trade and risk management. Okay, risk management is different from trade management, and trade management is different from risk management. We will talk about these things later. Okay, so right now, according to trade management, I should move my stop loss to my entry so that when the price begins to come down, I will not lose anything. Okay, so let's play the market and see. You can see that the market didn't go to our expected area. It came down. So I will have taken some profit here or here, and then set my stop loss to my break even. In this case, when the market comes down, I lose nothing. Okay, so now let's focus on the structure. So we can see that the market broke this higher low, which was our 4-hour POI or 4-hour point of interest. Since this low is broken, we can say that the market is in bearish trend. And can you see this? This is SMS, shift in market structure, because this low, this low was supposed to be higher than this high, because from here we are having higher highs, higher highs, higher highs. So this high was supposed to be higher than this high, but it couldn't. It gives you an idea that no, the market can change from bullish to bearish. So this is an SMS. Shift in market structure, SMS. So let's label it. We had our SMS over here. Had our SMS over here. Had our SMS over here, and then boom, we broke this structure. So now I will talk about bearish market structure and then either ranging next time. Good. So this is bullish market structure. As we all can see, this is bullish market structure. So I will end here, and then the next time we meet, or the next video, we are going to talk about bearish market structure. Go and practice everything. Make sure that you understand everything. Thank you.